You're listening to Questioning Your Sense, where you get real-world, pragmatic tax and financial advice for business owners, entrepreneurs, and independent contractors. Here are your hosts, Kevin Molen and Charles Steinmetz.
Hey folks, welcome to Questioning Your Sense. I'm your host, Kevin Molen, and our co-host today is Charles Steinmetz. Charlie, how you doing?
I'm doing good. Tired, but good. It's normal.
Fantastic. We're going to go ahead and jump into this. What do you want to tell me about today, Charlie?
I really had a loss of what Stephen was talking about. That thing was really pressing, but then I remembered something very important. The battery saver feature on a phone is a lifesaver. I did not have my charger, and I was at 15% at night, and my alarm still went off. So battery saver modes are awesome.
Does it happen automatically?
No, I have it. It's a default. I have it on all the time for my phone just to stay as long as possible. So.
Oh, gotcha.
Yeah, but it's good.
Mine turns off automatically whenever I'm at 100%. So if I have it on and then I charge it, gets to 100%, turns off.
Oh, no.
But you're an Android user, so
right,
whatever.
Right. I'm smarter. And then what would you like to tell me about today?
So about a week ago, Supreme Court Justice Ruth Bader Ginsburg passed away, and may she rest in peace. And so Trump on Saturday announced his Supreme Court Justice nominee, and we'll see if she is ratified, but it's Amy Coney Barrett. And so I consume quite a lot of political content, and so that made for definitely an interesting weekend because a lot of people have a lot of different opinions on that nomination. So, that nomination is going to go to the Senate for ratification.
Sure.
It being a Republican-controlled Senate, the assumption is that that's going to be ratified. But it was definitely an eventful weekend for news, that's for sure. We also heard a little bit about Trump's tax returns. So there was some information posted by the New York Times. So saying that he paid a whopping $750 in taxes in 2016, the year that he was elected. So we'll see. It's going to be really interesting from a tax perspective. Obviously, Charlie and I are doing hundreds and hundreds of tax returns a year. I don't know if you recall, but in 2016 we looked at 15. Was it 15? Was it 16? I think it was 16.
Year, yeah.
We looked at Hillary Clinton's tax returns.
Yeah.
Yep, exactly. So that was super interesting.
Right.
Trump obviously has a lot going on with his business, and so that'll be interesting to look at if those get released publicly.
How they get there, because the math is possible to get down to that much, but that sounds weird.
A lot of capital gains.
Sure, or like real estate for I don't know.
Yeah, exactly. Depreciation and all that stuff. So yeah, it'll be interesting to see what happens.
So we're talking about Roth and IRAs, retirement in general. I was thinking we need to start the conversation with something on just, do you need to contribute to retirement, why it's beneficial to, or just dive right in.
Yeah, so let's operate under the assumption that each of our listeners knows that they should be contributing to their retirement accounts.
Sure.
And if any of you listening or watching have a different opinion and think that you might not ought to be contributing to these retirement accounts, I would highly encourage you to submit a question or let us know your thoughts on that. Mention it in the comments on our YouTube videos or shoot us an email at info@molentax.com, info@molentax.com. Would love to hear your viewpoints on why you think that mathematically you should not be contributing to your retirement accounts, because we're going to have a discussion about it and I'm going to win. So anyways, talking about that, I think that everybody knows that you should.
Sure.
I think more it becomes a question of how should you.
Okay.
So, like you mentioned, we're going to talk about Roth IRAs today. We're going to talk about traditional IRAs and some of these types of retirement vehicles.
Gotcha. So thinking of, you mentioned vehicle, it's used commonly in the retirement conversation world. One that strikes me, and it's something that I have a conversation with people that I get that aha moment a lot in their eyes, at least. And so I think it's important to talk about what a vehicle is.
That vernacular.
So, yeah, big words, yes. Small words, this guy here, if I can. I'm going to break it down. So the vehicle side of things, how I understand it, how I explain it, is the vehicle is more like the rules, right? We talk about Roth, we talk about IRA. We could easily call that's the type of vehicle that you're in, a car, truck, bus, whatever that is. sometimes it gets easily confused on, well, my IRA, my Roth IRA, will perform this way. It will gain so much money like this, or my traditional will gain so much money like this, versus my 401 or whatever retirement vehicle that I have. And it's important to distinguish the vehicle doesn't determine how it performs. The vehicle determines how you get in and out. You get in and out of a car differently than a truck. It's just how it works. You pile a bunch of teenagers in a car, and they're going to act the same way that a bunch of teenagers are going to be if you pile them in a truck. Same kind of thing with your investments. The investments, the pieces of what's in the vehicle, can perform in the way that you want them, or we all want them to perform. You can at least choose what you're putting in the vehicle. And that doesn't matter. So whether it's your 401, a Roth IRA, traditional IRA, the investments themselves are not necessarily what we're discussing. What we're discussing is the vehicle itself, how you get in and out of that vehicle. It impacts some of your taxes. Sometimes you can and can't put it in, but it's the vehicle itself. And so when we use that term, we want to make sure that we're on the same page with that.
Yeah, and the individual investments, you're talking about within the investment account, right? The individual investments, how you invest. I know we're going to get into kind of 401ks and some of the differences there, but yeah, the investments themselves within the account can be very similar between a traditional IRA and a Roth IRA. But we're not going to talk too much about the similarities between the two accounts today. I think we want to focus on the differences between the traditional and the Roth. So why don't we dive into traditional IRAs first?
Sure. So on the traditional side, IRA side of things, literally it's going to be your traditional, your normal way of thinking it. What I would think the most of the world is going to think of hey, I put money into my retirement account. It lowers my income. And that's our normal thing to do. That is the traditional IRA.
Why is it called traditional, Charlie? Why is it referenced as traditional IRA?
I just said it.
So
I actually don't know what you're leading towards. So I'd love to hear this one too. I'm going to go, oh yeah, or I'm going to go, oh really?
So obviously using the word traditional, right?
Yes.
Because Roth IRAs were first introduced, I think, in 1989 was when they were very first introduced, but they weren't widely available or public. I forget the actual history of it, other than the fact that it was in 1997 that became a public option, right? Okay. So in 97, people actually started being able to contribute to Roth IRAs, which is not that long ago. I mean, traditional IRAs are much older than that.
Sure.
And so I think it just is naturally called a traditional IRA because it is the traditional type of vehicle, if you will, retirement vehicle outside of the 401k.
So how put those two things together? So you give me the IRA, but now that they mentioned the new one, we have to call it something else. So
and then Roth, I don't remember why it's called a Roth. If it was an acronym or if it was a congressperson's last name, Roth, or something like that. I'll have to look into that. I'll see what I can find out.
I got a special story for you, but I don't know. So I'm lost.
You're forgiven.
Oh, thank you. So more on the traditional. So that was the intro piece of the traditional of that you can put the money in. There are some important pieces with the traditional. I'm looking at my notes. It's going to happen. So the traditional things you put the money in. In theory, you're taking a deduction. I'll explain the theory in a second. So if you take the deduction, when you take the money out later, it's just normal income, normal tax at that time. So the idea, put the money in when you're making lots of money. So you take the tax deduction when it's high, and you take the money out later whenever you're retired. You're at a lower tax bracket. You take tax when it's low. So that's great. There are some limitations. So when you can contribute, there's a limit of how much you can put in. $6,000 unless we're talking 2020. I don't know what year you're listening in this one. 2020 you can do this. If you're over 50, you can there's a catch up, you can do an extra $1,000. So 7,000 is your limit. You've got, which is interesting about IRAs in general, is that you don't just have the calendar year to make them, because it can be a tax strategy to put the money into your IRA account. You actually have until the tax deadline to put the money in, meaning if we're right now in 2020, which means that people are going to be filing their 2020 tax returns through April 15th of 2021. That's when you have until to make your 2020 contribution as your limit. Now, traditional IRAs are special. You can always put money into a traditional IRA. However, it does determine on how much you make, whether it can be a deduction or not, which is a complicated piece. The numbers are precise. They're adjusted for inflation, meaning they go up a little bit every single year. Loosely, you can, if you make up to $100,000, then you can put the money into the traditional IRA. If you make it, unless, sorry, there's some twists and turns in this. The traditional IRA also dictates if your plan at work offers you a 401, or your spouse's does. That dictates the threshold of how high your income can be before it matters. Before you can make a deduction for the IRA.
So what you're saying is it's super complicated, and our listeners who want to potentially make contributions may need a tax advisor, a competent tax advisor. Shameless plug, right? Give us a call. We're happy to give you some direction.
So it's pointed based on your individual circumstances, but 100 and 200,000 are kind of the general limits on that as far as that goes. If you're not participating in any kind of 401k plan, you're a self-employed worker, you don't have a limit, you can always put the money in. There's other options for you, but you put the money in onto that. So that's
doesn't matter your income, right?
Correct.
Theoretically, you make 7 figures, doesn't matter.
Correct.
If you make 7 figures and you don't have your own corporation with your own, 401k plan, that's its own issue, right? This is why we exist, is to give people advice like that. But theoretically, there's no income limitation in regards to traditional IRA contributions.
So I try to keep this to a minimum thing. We're going to have to dive more into the traditional things after a second, but why don't you try a stab at keeping Roth fundamentals to a simplicity and show us how it's done.
Alrighty. So as far as income limitations in 2020 for Roth IRA contributions, Roth is a little different. Okay, so I'll dive into the specific numbers here in a second. First, let's talk about the theory behind the Roth IRA structure. Okay, because the Roth is the newer of the accounts, right? So the traditional IRA, Charlie's talking about, we get to deduct put money into this traditional IRA. We get the write-off, which is upfront benefit right now, okay? And so let's say you make the max, which is $6,000, like the traditional IRA in this case specifically, as you mentioned, is $6,000. So let's say we put in the max of $6,000, right? And then that money over time is called, or in a what's called a tax deferred account. Meaning as the value of the account goes up, or even if the value of the account goes down, none of the activity in that account is income that is taxable, or if it's a loss, it's not a deductible loss.
It stays inside the vehicle.
Yep, everything is within that vehicle, as Charlie explained. And so it's tax deferred. And then down the line, sometime in the future, you take money out of that IRA, and it is taxable, however much you take out. So if you contribute over the lifetime of the account, let's say you contribute $100,000, and this money is invested over a 30-year period, so you're going to see some performance on that. And let's say it's $250,000 by the time you're taking some money out. And let's say you want to take out 10% of the account every year for 10 years, and so you're taking out, just for simplicity of numbers, you're taking out $25,000 every year for the next 10 years. That entire $25,000 is taxable. Correct. It just counts as income. And as Charlie mentioned, hopefully at that point in your life, your income is less. And so you're in a lower tax bracket. So you got the write-off when you had higher income. And now you get the tax hit, if you will, right? It's taxable income, but at a lower tax bracket. So so there's kind of some of your benefit. And we'll dive into some other concepts here in a little bit as to why that's beneficial. But the Roth is different, okay? The Roth is also a tax-deferred account.
Correct.
But you don't get the upfront benefit of deducting your contributions. So in the traditional IRA case, you put in $6,000, and let's say you are in a 20% effective tax rate, and so you get $1,200 in tax savings on that $6,000. You can measure your tax benefit right away, right when you put the money in. Okay, I pay myself $6,000 for my future self, and I save my current self $1,200 in taxes. That's not a bad shake at all, right? The Roth is different, okay? The Roth, you put the money in up front, but you don't get the deduction, which means that money that you earned is still taxable.
Right.
So again, assuming a 20% effective tax rate, not only are you putting $6,000 in this account, but you're also still having to pay $1,200 in taxes on
Correct.
it. It's a pretty big swing. So why? Why on earth would I put money in a Roth IRA in that instance? Because that money grows tax deferred, just like the traditional IRA,
They're the
tax
same.
deferred up and down, hopefully a lot of up, and no taxable income.
Right.
The key point here with the Roth IRA is you have to have the account open up for 5 years,
Right.
and you have to attain the age of 59 and a half. And if both of those factors are true, then at any point after both of those are true that you take money out of the account, not a dollar of it is taxable
Zero.
income.
Which is awesome.
None. Yeah, which is fantastic. Now, the traditional IRA, you get some upfront tax benefits,
Correct.
right? But then it hits you on the back end eventually. The thing with the Roth is that assuming the account grows over time,
Correct.
then it's tax free. So I will tell you, there have been a really tremendous amount of simulations run for a 17-year-old that has income, adjusted gross income of at least $5,000 every year, who puts $5,000 into this Roth IRA for 10 years. So from 17 to 27. Now, how should a 17-year-old invest, Charlie? They're nowhere near,
Aggressively.
they're nowhere near retirement, right? So super aggressively invested. You're
Right.
going to see a lot of highs. You're going to see a lot of lows, right? But from 17 to 27, you put in $5,000 in 10 years, $50,000. Okay. By the time that 17-year-old is 65, that account is now $1 million.
Sure.
Right. A really tremendous amount of scenarios and historical scenarios too, right? Taking how they would have invested over this 10-year period and it turning into at least $1 million. So, that's not a guarantee of performance and that kind of stuff, but you understand what I'm talking about. I'm talking about mathematical scenarios. And so I certainly wasted $5,000 a year every year from 17 to 27. And I wish that I had not wasted some of that money, but
Of course, I have $5,000 of something. Are you kidding me? But
well, I know you were working at Chick-fil-A and biking to work and all that stuff
I
prior
was,
to
and then
17.
I dug up some records and stuff and found some of those
Yeah.
W-2s as
Oh,
they
cool.
were.
Yeah.
Yeah, it was a lot less than I thought. It was a lot at the time, but it was a lot less than I thought.
Yeah. So just for reference, right, I have worked at Molen Associates since I was 10 years old. Charlie was working since he was 14, at least for other companies. I'm sure there was other work that you were doing. But I saw Charlie's work ethic. We would be driving down, over here off Cutton Road, and I would see Charlie on his bike biking to work. And so I can
I need to again, but I mean,
right. I'm a witness to Charlie's good work ethic. Anyways, don't want to derail too much. The Roth IRA account, Charlie, you know me, I can never explain something simplistically. I got to give you that.
I dared you and you failed.
No, that's okay. That's okay. It's still super valuable. So that's the general premise of the Roth IRA, right? Is you get the tax savings on the back end. And they stand to be significantly more tax savings than the traditional IRA.
So let's put a number to it, and just sometimes this is piggybacking on this is the number that I throw out there sometimes. So that did you start with 100,000 to 250? We're going to start that.
Yeah,
so
sure.
$100,000 is your initial investment over time, and then it grows to 250. We'll get into some differences on how much you can put in. There's some pieces there, but let's assume equality. Roth IRA, traditional IRA, those are the vehicles. The teenagers and slide-all investments were the exact same. And so those two different accounts, what happened? The $100,000 of the traditional account, you got to write off on your taxes. You paid no taxes on $100,000. And then when you take it out, the $250, you pay taxes on all $250. The Roth IRA, you paid taxes on the $100, and then when it's $250 and you pull it out, you paid $0. And so it's a difference in paying tax on $150,000. And so one could easily point that out and say, well, clearly this is the better choice. It's not that easy, but at least to paint the picture of why Roth could be attractive.
Yeah. So let's put a pin in that for a second,
Yeah.
just so I can give a little bit more information on the Roth. I want to come back to that though. The Roth has some limitations, just like the traditional IRA. So the first limitation for the Roth is an income limitation. For married filing joint, the number in 2020 is $206,000 of adjusted gross income. So if your adjusted gross income is greater than $206,000, you do not qualify to put any dollars into a Roth IRA. Okay. There are some unique tax strategies to help around that, but we're not going to dive into that today. For kind of that threshold for single filers is $139,000. So if you're a single filer, you earn more than $139,000. Too sad, so bad. Cannot put money into a Roth IRA. At
Did
least
you
without.
say that backwards on purpose?
Yes,
That was funny. I
Yeah.
liked it. I haven't heard that yet.
Anyways, so you got to look at your adjusted gross income, look at your tax return, determine whether you can contribute to the Roth IRA. Now, coincidentally, it also happens that people don't necessarily know to the penny what they're going to earn or what their pre-tax deductions are before December the
What?
31st, right?
How on earth would you not?
So there's a
Reason.
reason why you can contribute to these accounts leading all the way up to April the 15th of
Right.
each year, because someone like me can tell you what you qualify for and then what is better for you. So we assist our clients with that type of information. So now we put a pin in what you were talking about.
Yeah.
Let's take that out because I want to cover because you illustrated well the difference in at least taxable income, right,
Correct,
between the two
correct.
vehicles.
Just to paint the picture.
And so if the Roth, if I can avoid paying taxes on $150,000 in the
Correct.
Roth, I'm going to ask you a rhetorical question. I'm actually going to answer it. Okay. But why on earth would I put money into a Roth IRA, or I'm sorry, into a traditional IRA as opposed to a Roth when the Roth is so clearly better for income tax purposes? So now I'm going to answer.
Ooh, tell us.
And primarily it's for two reasons. Number one, money is a finite resource. We only have so much of it.
You don't have that tree in your backyard?
I do not.
Oh,
I've been
okay.
working on it, but they're called children, and hopefully one day they'll be able to print money for me. But for now, they're 11 years
The
old, 8
opposite.
years old, and 19 months old, so they are money vacuums, not money trees. But love them anyways. You're gonna get me off track, Charlie. Get me in trouble. So the Roth IRA, the difference between the two, right, being so stark. Why? Because money is a finite resource, right? So we only have so much of it. And so if I can afford $4,000, for example,
Sure.
well under the contribution threshold limit,
Can't
if I
let
can
that-
afford to put $4,000 into either a traditional IRA or a Roth IRA, it's really simple. Again, assuming a 20% effective tax rate, you can't afford $4,000 into a traditional IRA. In fact, you can afford a little more because by putting in $4,000 into a traditional IRA, you're saving $800 in taxes.
Right.
So I theoretically could afford $4,800 into the traditional IRA, right? As opposed to $4,000
Right.
into the traditional IRA. As opposed to the Roth, I got to pay the taxes on the money. So if it's $4,000 into a Roth, it's
This is my
$4,000.
limit.
Right. Now, you repeat that enough times
Yeah. Mm-hmm.
and you put $4,800 into a traditional IRA and $4,000 into a Roth over enough years compounded, that ends up making a big difference. So
let's take your example of the 17-year-old who put $5,000 a year for 10 years and say instead he put $4,000 a year
Yep.
for 10 years.
Yep.
It's not going to be $1 million. Maybe it's still really strong.
right.
We should do the math. But we haven't done the
Yeah,
math.
yeah, yeah.
Let's just call it 780,000.
Right.
Great. There's a difference between 780,000 and $1 million. It's
Yeah.
still a lot, but the thing that we're driving at is, I think your term
Yeah,
is principal
so-
investing power.
Yeah,
correct?
exactly. So the concept is principal investing power. How much you invest determines what your return is. The more you invest, the greater your return.
Correct.
But when you have a greater return, now you have more to invest, right? So the term is the rich get richer for a reason, right? Because not just because it's systematic, right? It's math. The more money you have to invest, which compounds and earns you money,
Mhm.
the more you can invest, right? So it's a mathematical concept, not a systemic concept, and math proves it out.
So I think of it almost like Monopoly. I've literally just thought of this right now, right? The first person who gets the hotels and then people land on those hotels.
Mm-hmm.
I'm going to hope that most everybody listening to this has at least played or watched Monopoly played. As interesting as that can be, I think playing is better. But so you get the hotels. Someone lands in those hotels. What is that person then going to do with that money? Get more houses and hotels.
Yeah.
And so if the person who keeps landing on them doesn't get that influx, and so it's this compounding.
Yep. Same concept, right? It's a mathematical concept,
Sure.
right? And so that principal investing power makes a big difference. So, if what you've decided is I can contribute the max to either account,
Sure.
right, regardless of the consequences. Now that's a different conversation, right? Because now, depending on how many years you have, right? So now becomes the next issue, right?
Yeah.
When we're comparing the traditional vehicle
Yeah.
versus the Roth vehicle, now the issue is how many years do you have before you're going to take money out? Because if you're going to take money out in 6 years, how much can your Roth IRA actually grow? Right? If you need access to that money in 6 years, you're not going to get enough growth to make it worth it, right?
Tax savings.
Yeah, but if you know your tax bracket is going to go down quite a bit by the time you retire and you start taking that money out in 6 years, well, now the upfront of the traditional IRA is just superior, right? Mathematically, it's just better. So, it's a little difficult between the two. Roth IRAs are a little better for inheritance purposes, right? So if you want your beneficiaries, if you know your beneficiaries are going to potentially receive all or a portion of these accounts, the traditional IRA is a little more difficult, and I think we're going to go into some of that here in a second. You want to dive into that now?
I was just I was like, well, I was supposed to jump into that over there. And I was trying to tell it.
The mind link.
It worked. It worked. So.
You want to lead us off on?
So.
Oh gosh, Charlie.
Tacos. It doesn't work. So, the age thing, passing, right? Those who are passing and inheriting these retirement funds, spouse to spouse is generally an easy transition as far as that goes. Rules are really relaxed, just as, in essence, a seamless thing as what's supposed to happen. What's not as seamless is whenever it goes to a non-spouse, right? Whoever beneficiary that may be, whether it's your best friend or typically a child or a grandchild, that type of thing. And so the Roth side of things, what's nice about that is my understanding, now please correct me because my understanding is not perfect, but in essence, the ownership transfers.
Mm-hmm.
It is now that person's Roth IRA. And so it's subject to their rules at their age and all of that stuff. They inherit like the 5 years in existence type deal, but everything else, it's just now theirs, which is great.
So let me interject because there's a reason why. Because Uncle Sam has no hope to really get any taxes
because he already got paid
from this account.
Right. Because
that you already paid taxes on your earnings up front with a Roth, right? So look at it from the federal government's perspective. This Roth money can go tax deferred forever, right? It's not a big deal because they're never going to get taxes on the money when you take money out of the account, and so it's the reason why you're talking about that part.
So the traditional side of things is different, right? Because Uncle Sam has been waiting to tax this money, right? Yeah,
money,
exactly,
cash money.
So there's another pen as far as when they make you take it out, but when it passes on to those that follow, there have been / are certain rules around when the timing needs to happen.
Well, it got more complicated.
It changed recently.
Well, I say more complicated. It actually probably got a little less complicated
simple,
recently.
Right. More frustrating, but
yeah.
Simple.
So the Secure Act was passed at the tail end of 2019, and that brings in a whole bunch of changes for us here in 2020, specifically in regards to inherited IRAs.
Correct.
So in the cases of a traditional IRA that has been tax deferred, right, during that whole period of time, and then someone dies. Owning a traditional IRA, and that ownership needs to be transferred to the beneficiary, right?
So Aunt Betsy, who lives in Maine, gives you her IRA of $50,000.
Yep.
Great.
Let's talk about niece Betsy rather than Aunt Betsy, because there are some rules in regards to age, right?
Sure.
Because when you're close enough, I think it's
Fair.
within.
Yeah.
Is it 5 years or 10 years? I think it's
R&D?
10 years. If you're within 10 years of the age of the person who passed away, then you're not under these new rules. But basically, the new rules are you have to take the money out of the account within a 10-year period, right? So if it's $1 million in a traditional IRA, you got to take out $100,000 a year out of these investments, out of this tax deferred vehicle, all taxable as income, compounding your tax rate with all of your other earnings. So it's pretty rough. The idea behind the Secures Act, which I don't hate the idea behind it, but the idea behind it was to remove some of the tax burden from the retirees and place it upon the inheritors. So I don't hate that idea, right? Because the people who are inheriting the money, they're already kicking along and surviving without this inherited money, right? And so them paying taxes on it, I believe, is better than someone who is living on a fixed income, a retiree, paying more taxes, right? And so, and like you said, we put a pin in that, but we're going to get back to it, the taxability of these accounts. But you know, in that scenario, I favor the inheritor paying a little more taxes and the retiree paying a little less taxes. Puts less burden potentially on the federal government, having to, you know, for Social Security benefits and all that kind of stuff, and puts more burden on the person who's getting it, who it's call it gravy. Maybe that's you know, insensitive of me,
theory. This
but
is
it's
all
extra.
just extra for you.
Yeah.
So
Yeah.
be happy. I would be happy. If you're not happy, I'm happy to take care of it for you. It's just
Charlie will pay the taxes and pocket the difference.
Absolutely.
Yeah.
If that $100,000 every year is just too burdensome for you, I will take it. I will take one for the team.
Man, what a
And
guy!
I would love to have a lot of teams. So please.
What a guy! Okay, so let's take the pin out of then the required minimum distributions.
Sure.
So this is a term that I use deliberately. Required minimum distributions is a term within the tax code, specifically in regards to the federal government saying, look, we're going to give you access to these tax deferred accounts, but you cannot defer taxes indefinitely.
Forever.
Right? You can't. The federal government eventually wants to tax the money. Now, the federal government is I'm talking about them like they're a person, understands math, right? So if the federal government allows us to defer taxes on money, that means they also understand the concept of principal investing power. The more money you have in the account, the more money it earns you. The more money it earns you when you take the money out, the more taxes you have to pay.
Right.
So federal government says, we will wait. We will wait. We will let you put more and more money in this account. And that way that money can grow, right? The more it can grow, the better off the federal government is on several factors, right? The less money you have, the more of a burden you are to the governmental systems. And so anyways.
The more you have, economically speaking, you can put it into the economy and you can pay more taxes.
Yeah,
so
precisely.
it's
Absolutely.
a fantastic little sheep drum.
Yeah, it's just math. It's math. I understand that people, make political figures make policy based on a lot of factors, and not all of it is math. But I'm a math guy, right? Sitting in this chair, I am a math guy, and so that's what I care about. That's what I'm looking at. And so this makes sense to me mathematically, right? And to some extent the federal government as well.
So there's a lot of things the IRS has just drawn imaginary lines in the sand, right? One of them was the limits on when you can put into the retirement account. And so they have to pick numbers. They have reasons for them, but they pick numbers. So the number that has been picked now for these RMDs, the one that's going to be in everybody's mind, because it's been there for a long, long time, is 70 and a half. Those who have already reached that age and are already paying these RMDs, that number stays true. The Secure Act that was recently changed, that added this, changed that number to 72. So if you have not yet started your RMDs, then you're under the new rules. And
so what you're telling me is that under the Secure Act changes, after attaining the age of 72,
correct,
I now am forced to take money out of my traditional IRA term?
Yeah. All of it. No, not all of it. How much? It's a tough number.
Well, yeah. So now that's based on a calculation. It depends on your age, whether you are male or female. It depends on your spouse's age. Depends on a bunch of stuff. Ultimately, it's about 3 to 5%, right? And so that the
In
calculation
that first year at least.
Yeah, but the calculation is generally around those numbers.
Right. So, but it starts there. It's like it's age based. So once you hit like 95 or whatever, isn't like half the account or something. I mean, you can't just go on forever.
Yeah, the
It gets a
number can
little
get
bit
higher.
bigger and bigger as time goes by. But so you're forced to take this money out. It's important to note that this is a required, keyword is minimum distribution. If you have set up your retirement to already be drawing money from this account, the required minimum distribution just means, hey, out of this retirement account, you have to take out at least this much. If you're already taking out at least this much, it's not an additional distribution you have to take. It's just you're already doing it. Another key piece with this is to know that for the tax deferred accounts, technically including 401s, but the RMD requirement is a federal requirement for the year, not for the account. So if you happen to have an IRA with, we'll just pick random common ones, Charles Schwab and Fidelity. You have an IRA with both, they're both traditional IRAs. Charles Schwab and Fidelity each are going to send you the little paper that says your RMD for us is this number, because they have obligations they have to fill, right? But you can take an RMD from each. You also can combine those two numbers and take your minimum amount for you as a taxpayer from one account, as long as it satisfies your retirement obligations for all of your tax deferred accounts.
Yeah, and then you got to notify. So let's say you take it all out of Fidelity, right? So let's say that Charles Schwab has just been performing better, and so you take the money out of the Fidelity account as opposed to taking it out, a portion here and a portion there. You have to notify Charles Schwab that you did meet your required minimum distribution, right? Because otherwise they may think that you'll be subject to a penalty and all that kind of stuff. So you got to make sure and communicate with your financial advisors in that capacity.
But there's a reason for the RMD as well. So yes, it wants to be taxed. We gave you the I guess the theory behind the whys of it. But there's also an important why for the person. Why do you need to take the RMD? So the penalty was the one that I'm thinking of. But
oh yeah, the penalty is insane. So let's just very briefly, right? Because this isn't an RMD conversation in depth, but this is an important factor. If you have attained the age where it is necessary for you to take required minimum distributions, and let's just say that your required minimum distribution is $20,000, right? So let's say that's 3 to 5% of the account, and so you've got to take out $20,000. That required minimum distribution penalty. So if you don't meet your required distribution,
you take nothing out because you wanted to save more.
the penalty is
Or you forget.
50%, not 15. 50%.
Yeah.
So 10 grand, the federal government can penalize you by not taking out the 20, which is insane. I mean, that's a really crazy penalty.
Yeah.
But I'm not sure if you were leading somewhere else.
That's exactly where I was
but I
leading.
did,
So
I did want to mention that.
I mean, there's the whys of the, hey, they want to get a tax, they want to go put the money in the economy, all good things. At the same time, there's another incentive to taking your RMD. So it's required on multiple fronts. You want to, because you don't want this penalty.
Yeah. Now the thing is, if you like the investments that you're in, you can take the money out of the Fidelity account in that hypothetical scenario,
Correct.
and then talk to Fidelity and say, hey, I liked where this was invested. Can you just put it in a brokerage account and invest it again in the same investments? Right. Or if you say, hey, I like, as I mentioned before, I like the Charles Schwab performance more than Fidelity. You can just walk that check over to Charles Schwab and say, I want this in a brokerage account. Now that's a little different because now it's not tax deferred, right? Like the traditional IRA or the Roth
IRA. You can't put it back
IRA.
into an IRA, which is an important piece.
Yep.
You can't just move it. It's cheating. And they figured out the cheating, so not allowed.
Yeah. And so in that scenario, you can put the money in a brokerage account, but that's what the industry will call a taxable account, meaning as the money grows or as the money loses, that activity is taxable potentially on your tax returns. We got to deal with some of that. Okay, you mentioned 401ks. Why don't we close us out with that, referencing the difference between the 401k and the IRA.
So the 401k is tied to your employer, essentially, right? So it's done through payroll. It's done not necessarily automatically. You decide how
automatically.
It's a lovely word, but it's done through payroll. So it's something you have to like set the account up, make the check out, send it over there, and do those things yourself. You set it up and it can happen on an automatic type basis. The limit to put into a 401, how much you're allowed to put in, is significantly higher.
Is it 19,000 in 2020 or is it still 18.5?
It's almost 20 grand. Is how much you can put
I
into a
think
retirement
it's
account.
still 18. I think it's still 18,500 for 2020.
Right.
And so
then
that's
a little bit more for those who have the catch-up contributions as well.
Yeah.
For those of age.
it's
hit
24,000, right? So
50.
so Charlie, once you attain the age of 50, you can make what's called catch-up contributions. So Charlie mentioned it in regards to the traditional and the Roth IRA. It adds 1,000 to your limitation. The 401k, obviously, if we take the traditional IRA at $6,000, or you can contribute 7,000 if you're 50 years old or older, and the 401k at 18,500 or 24,000 if you are 50 or older. It's a lot more that you can put into. That's step number one, right? So remember the concept of principal investing power. Step one is how much can you afford to contribute? Again, money is a finite resource, but you can put a lot more into a 401k.
Yeah. What's also nice about a 401k is there are no income limitations, right? So you could make $400,000 a year, which in theory you can't put into either of these accounts and gain their benefits, but into a 401 you could. And so that's nice. Now there are 401 that are Roth, there are 401s that are traditional, and so the concept of that vehicle, the theory behind it, still applies in that fashion. 401s do carry their own R&D requirements. However, they're technically suspended while you're still employed. So if you are 76 and still working for the employer making contributions to your 401k, you don't have to take the money out. But the year you retire, then they start.
Yeah.
Right? Otherwise, it'd be 72 like normal.
Yeah.
And so, what other tidbits would you add for 401s?
So the 401k, one of the issues with the 401k is you're limited in your investment selection in many cases. Now, some 401k plans allow you to self-direct your 401k, in which case you could have a financial advisor assist you in how you want to invest. But by and large, most 401ks have age-based funds. So basically, for example, you say, well, I'm going to retire in, 2060. Right? Well, okay, then that's a fund that's based on the year of 2060, which means, so I'm going to nerd out a little bit, and I'm going to get on my soapbox here for a moment. I think this is our first
saving them up.
soapbox today, which is good. So getting on my soapbox for investing purposes. Remember, I referenced the 17-year-old, and I asked Charlie, how should the 17-year-old invest? Because they're not going to retire until 2080 or whatever. Yeah, that's about right. Anyways, and so in that scenario, you need to invest hyper aggressively, right? Because you have so much time to experience all of the highs, and you're going to experience some major lows. But when you experience the low, there's been no 10-year period in the history of the United States markets, including the Great Depression, where the markets have been down. There's been no 10-year period, including the 2007 and 8 recessions and everything. There's been no 10-year period where the market has been down. That's not a guarantee of future performance, but I am a math guy, right? I don't know how many times I'm going to say that, but I am. And so looking at that math, I like that. Those calculations. And so in that scenario, that 17-year-old has a lot of 10-year periods before they're going to retire. So you can invest super aggressively. In that same using that same logic, the 58-year-old who's going to retire in 3 years, they cannot afford a bad year. They can't. So you cannot just blanket invest, right? I'm a relatively aggressive investor, and right now so I've got the 401k and I've got it going into the Roth portion of the 401k. Again, I'm a math guy, right? I think the Roth option is very attractive. And so I've got money going into that 401k. I have the most aggressive investing options available, and my 401k has kind of bounced around a lot this year. 2020 has been an interesting year, but the reality is I'm not going to retire in 10 years. I've got plenty of time, and so I want my money working for me. And so that 58-year-old, if they invest the same way that I invest, and the money goes down horribly the year that they retire, they can't make it up. They don't have time to make it up. I've got plenty of time. If 2020 ends up being a horrible year, I can make it up big time. No problem over an extended period of time. And so how you invest matters a lot. So I'm gonna get off my soapbox, right?
Okay.
But the 401k in and of itself, right? How much money you have in there versus the traditional IRA and all of that, and how those accounts are treated. All of that you have to take into consideration when you're looking at the math. How much am I going to put in? When am I going to take the money out? How should I invest? Because the 401k has these age-based funds in most cases. The idea behind this age-based fund is it's very aggressive right now, right? And so if we're looking at an age-based fund of 2060, right now it's super aggressive, right? And then by maybe 2045, it starts to, instead of being 90% stock and 10% bonds being safer, generally speaking, and stocks being more volatile, which potentially has a lot more potential for income. Right. So this age-based fund at 2045, it starts to slow down. Instead of a 90% stock and 10% bond, it transitions to 75-25, right? And then by 2050, it's 60-40. And by 2052, right? You get the idea here, right? It phases out more stock and brings in more bonds. And the closer you get to retirement, I mean, within 3 years of retirement, you're sitting on 80% bonds. Right. Well, now if the market has a great year, a couple of years before you retire,
what happens?
You're not going to get a lot of that value because you're sitting in bonds. Right. But the idea is you have to hedge against the risk of the market doing very badly right before you retire. Right. Because it could force you to work for another 3 or 4 years when you're ready to retire. So these age-based funds in the 401ks are okay, right? Theoretically, I understand the theory behind them, but it takes a lot of flexibility out of investing in a 401k. So I'm not saying that the IRA is always better than a 401k, but the IRA almost always has more flexibility than the 401k. Generally, fees in an IRA, account fees and administration fees, are lower in an IRA than they are a 401k. In most cases, not in all cases, but in most cases. So there's a couple of reasons why the IRA is better, but at the end of the day, the 401k can be easier, not subject to income limitations, and you can put more money into it. And so just for those fundamental reasons, the 401k is almost always the superior option.
Yeah, the easy answer
to
is
take.
Just...
Exactly. If you're not maxing out your 401k, and that's not even talking about match, right? Your employer match on your 401k. We're not going to dive into all of that.
That is your true minimum contribution as your employer match.
Yep. Yeah, free money.
Please.
Free money. It's guaranteed performance. Put the money in the 401k, get the match.
Yep. Agreed.
All right. Well, I think that covers all of the concepts and the topics we wanted to talk about. Were there any other kind of concepts you wanted to cover before we jump into our comfort zone?
Nope.
All right. Then let's get into our comfort zone here. Charlie and I love to get asked questions on the spot. We haven't heard these questions beforehand, but I think, Clark, you're going to share with us some questions from our listeners.
Yep, we've got 2 questions in today. The first one is, are there benefits to filing taxes early? What happens if I fail to file before the deadline?
Okay, 2 different questions. You want to take question 1 and I'll take question 2?
Okay, so what happens if are there benefits to filing early?
Correct.
Depends on how you define early, right? Some will define early as simply by April 15th, right? That's the early version of filing and not filing an extension. Filing early can have a lot of benefit in more the future-looking thing, from my opinion, right? So filing early, sometime February or so, one, it can help you, can we put money into this IRA type deal? What are our thresholds or limits on that can be an important piece. But also, if things have been changing a lot or you've been owing a lot, being able to catch something early, having a good tax advisor, another shameless plug, to come in and say, oh, hey, you owed $4,000 this year, make these changes so that you don't owe it again next year. For the person who took an extension and filed in August, that's fine. Now you're still 2 months early, and you're totally allowed to do that. However, if something needs to be corrected, you're already in August. And so either you're making big corrections for 4 months and then changing again in January, or you're just going to have 2 bad years in a row, make the changes now, and then the following year will be better. So there can absolutely be some advantage to or benefits to filing early.
Tax planning.
Correct. If you're due a refund, just getting your money faster. I mean, you
Yeah, of
can
course.
wait. You've got 3 years to claim your refund. You get paid interest. Please don't hold out for it.
Money now is better than money later.
Yeah, absolutely. Absolutely.
So the next thing that I'll say in regards to filing early, back in 2014, I believe it was, the big year of identity theft
Oh, sure.
and fraud on the tax
Oh, that's
returns.
a good piece.
Yep.
They fixed a lot of it, but it's
They did,
still
they
a
did.
valid point.
Filing earlier opens you up to less risk of someone filing using your social security number. Also for dependents,
Yeah.
right? So children on your tax return, there is risk potentially for someone else claiming your dependents if they have access to their information. The earlier you file, basically the first person to file claiming the dependent gets the
Essentially,
dependent.
yeah.
It's more complicated than that, but there are a couple of good benefits to filing early. For what it's worth, there is kind of one or two detriments to filing early in regards to tax law changes, right? So the earlier you file, the less kind of solid the IRS and the tax softwares are on exactly where everything's at. And so, I've got people who want to file on January the 3rd, and that's pretty rough, right? Having your tax documents, pushing everything through, that's a little early, right? By usually January the 25th or February the 1st, somewhere around there, basically everything's going to be more or less solidified. But anyways,
Right.
So then the second part of the question was, what are the negative ramifications for filing late?
So it's more what happens if you file after the deadline.
I see. Okay. So first, let's clarify what deadline means. The first deadline, of course, for individual filers is April the 15th. For our business filers, depending on how you're incorporated, generally it's March the 15th. And so let's operate under the assumption that you have filed an extension on your tax return. Well, now the filing date is actually either October the 15th for our individuals or September the 15th for our corporations. And so just vernacular, we need to make sure that we're operating under the same jargon, if you will. And so in the scenario in which you have filed an extension, then you're actually not filing late as long as you meet the secondary deadline or the extension deadline. But let's assume that you did not file an extension and that you filed late. If you are due a refund, generally speaking, for our individuals, there's no downside. You're not going to get interest, right, unless you file way late, as in years later. But if you're due a refund, penalties and interest are based on the amount that you owe. So if you don't owe, then there's no interest or
Charge me
penalties.
2,000% interest on $0. I'm still paying $0 in interest. So
That's right. Now, for our business owners, it's actually a little different. And so you got to follow my theory here for a moment. If you file after the deadline, the federal government says, hey, as a corporation, if you're a pass-through entity, right, you've got to pass through your profit, if you will, to the owners of the corporation. And the owners of the corporation have to file their tax returns on time. So if you are the decision maker accountable for when the business return is filed, and there's 10 other partners or owners in this business, all 10 of them have to file on time. But what if you don't get your business tax return done on time? Then you don't allow these individuals who the profit needs to pass through to on the tax return. You don't let them file on time.
Right.
It's part of why the deadline for corporations is a month sooner than for individuals, because you've got to give the individuals time in order to get everything filed. So the federal government says, oh man, I almost had another soapbox moment, but I'm not going to get drawn into it. We don't have the time for another soapbox. I'm going to resist. Can I? Yes, I'm going to make myself. Okay, so the idea here is that there can be penalties on corporations who don't file by the deadline. I have to slot it in real quick. Generally, these corporations don't pay taxes, and I'll go more into. I will soapbox
You're
that.
gonna get political here real quick.
I guarantee I'm going to soapbox that sometime in the future. But generally, these pass-through entities, S corporations and partnerships, do not pay income tax. The income tax is passed through to the
but
owners.
they can have penalties assessed
That's
on
right.
them
Because
for
they didn't
reasons,
because they didn't get it out in time, right?
Right.
So they're making these other individuals file extensions or be late and pay penalties, and so the federal government is real serious about these corporations filing on time. The penalties can be really severe. For partnerships, it's like $50. I think it's $250
like
for
per
filing
member or
late,
something.
but then it's $50 per partner.
Right.
So it's and if you've got enough partners and enough months of filing late, it's pretty detrimental.
Yeah.
But then on the individual side of things, if you owe, the penalties and interest can be quite significant.
Right.
So without going into too much detail, suffice it to say that there is a 0.5% late payment penalty. Yep. And then there is a 5% late filing penalty that can be charged for up to 5 months. So 5% per month, up to 5 months. And so 25%, I mean, that's pretty significant. You're talking about a 25% penalty. Now, it's 25% of what, right? Of what you owe.
Correct.
So if you owe $10,000, that's a $2,500 penalty.
Just for filing.
Just for filing late. So you cannot ignore your tax obligations. You don't have to do things perfectly, but you cannot ignore them. The IRS hates being ignored.
One thing I would add in that would be it's really, we go over it with almost everybody who owes, is the IRS unequivocally separates filing and paying. So you can absolutely file an extension and file your tax return by August. The payment deadline, unless it's a pandemic apparently, stays at April 15th and you don't change it. And so you get rid of the giant penalty of that 25% potential for filing. And so, but the payment portion will still do in April. And so there will still be that payment penalty and interest is going to happen regardless.
Yep. Question number 2.
Question number 2. What is the difference between an exemption, a credit, and a deduction?
Do you have 30 minutes? I mean...
I got 5 minutes.
An exemption, a credit, and a deduction. Let's put off exemption here for a moment, and let's talk about the difference between a credit.
But okay.
Yeah, let's talk about a credit and a deduction. So essentially, a deduction removes your income. Okay, so your income is taxed at a certain rate. Let's use the same hypothetical amount that we've been using, which is a 20% effective tax rate. If I get to deduct $1,000,
correct,
it doesn't deduct it from my tax. It deducts it from my income. So it's called a deduction. It deducts from my income. So we take a hypothetical person who earns $100,000 a year, gets to deduct $1,000. Now they recognize $99,000 of income. The standard deduction for a married filing joint filer is $24,400. For a single filer, it's half of that. And so, how much you get to deduct matters a lot for income tax purposes. It reduces your overall effective tax rate, reduces your income, so the base at which you're taxed is less. So what about credits?
So credits work how you want them to work, and they go against direct tax, right? So we take our income, you take your deductions, you arrive at your taxable income, and you calculate how much tax should be paid. Generally, you compare that to how much tax did you pay, or how much came out of your paycheck. But things like child tax credit, a credit goes in between. So you should have paid $10,000 in tax, but before you count how much you have to pay, we get to take off, let's say, a child tax credit, $2,000 of the tax. So now you only have an $8,000 tax obligation. So credits are fantastic. They're very far and few between. Most commonly is going to be kids in college, right? But credits are awesome in that manner for that purpose. So deductions are great. Please don't go chasing or creating deductions out of nothing. It's not worth the money itself. Keep the $1,000, pay the $200 versus find ways to pay $1,000 and save $200. I'd be bad at my job if I told you to go spend 10 to save 2. But I'm not bad at my job to tell you to have 40 kids. 40.
Holy cow!
Yeah.
So yeah, that's the number one misconception that I get towards the end of the year as far as questions from my clients is, hey Kevin, I've got some money. What should I spend it on so I have some write-offs? That's the wrong thought process surrounding deductions, right? Because if I'm deliberately paying $1,000 so that I can save $200, I am out $800. So if I didn't need to and I didn't want to, then why on earth would I spend that money? Now, if I need to spend it, fantastic. I get $200 remunerated back to me.
Right.
If I want to spend that $1,000, well, great. It's like it's, it only cost me $800, right? Because I saved the $200 in taxes.
Right.
If I need to, I want to, great. If I don't need it and I don't want it, don't buy it, because the tax savings are not there.
Right.
And for what it's worth, there's only one credit that I'm aware of. I think the adoption credit under a special needs situation. But generally speaking, no credit will save you more than what you spent, right? Other than the special needs adoption credit, right? Which you can qualify for the whole $14,500 credit, even if you didn't spend $14,500.
Correct. It's not refundable anymore, but yes, you get the
Right.
whole amount.
Right.
Child tax credit can gain you more, but anyway, that's
You're-
not how much you're going to spend on the kids.
I got
That's
3
just totally
kiddos.
fair.
You're spending more than
Totally
$2,000 each on them.
So the last part of that was exemption. That one is technically an old term. It doesn't exist anymore as the easiest answer. There used to be a deduction, keyword, per person listed on your tax return. It is no longer the case. They replaced it with essentially doubling the standard deduction. And so where there used to be a smaller freebie deduction per single or married person filing a tax return, they then increased that, but conversely, they took away the additional deduction that there was per person. That's what an exemption would be. So exemption, similar to deduction, they're the same, but one is gone.
Now, for what it's worth, the Tax Cuts and Jobs Act that was passed on December 17th of 2017 is not permanent.
Correct.
And so it at this point is expected to expire in December of 2025. We'll see what actually ends up happening. Many of the Bush tax cuts that were passed were made permanent. So it's very possible that the Tax Cuts and Jobs Act in some form or fashion will remain.
Moving forward,
It
yeah.
may be that the exemption deduction never comes back. It may be that we're in an election year right now, right? So
Things change.
if the
3 months.
Republicans lose the White House, then the Democrats may make changes, and so we'll see what ends up happening. Okay, I think that covers our questions for today. Thank you so much for joining us. If you like our content and you want to see more of us, you can visit us at www.molentax.com. If you have questions for us, we love to answer questions. There's a reason we call it our comfort zone. We answer questions day in and day out. So you have access to us at info@molentax.com. That's our email address. If you email us your questions at info@molentax.com, we will absolutely make sure one of your questions gets featured on our next podcast. So other than that, thanks so much for joining us, and had a good time. Good conversation. Have a great one.
Thanks for tuning in to this episode of Questioning Your Sense. If you haven't done so already, be sure to subscribe to this podcast, leave us a 5-star review, and don't forget to share it with a friend. If you would like to submit a question for our review on this podcast, feel free to email us at info@molentax.com.